Imagine a scenario where your savings generate exactly $2,900 a month, not as a one-time windfall, but as a consistent stream of dividends. This shows the scale of the traditional challenge. To pull $35,000 a year in passive income, you usually need a portfolio worth $2 million. For someone with average expenses of $67,000, accumulating $2 million in capital feels like an impossible mountain. This daunting barrier is why many people abandon the idea of living on dividends. But that $2 million figure is based on a narrow set of assumptions about market yields. The entire strategy shifts if you focus on dividend yield, the direct relationship between what a stock costs and what it pays back to you every year. This equation outlines the basic mechanic. You calculate yield by taking the annual dividend per share and dividing it by the price per share. As this percentage increases, the upfront capital needed to generate $35,000 begins to shrink. There are 3 specific market vehicles that can leverage this math to cut that $2 million requirement by up to 85%. Reaching your target isn't about hoarding millions, it's about choosing assets that optimize the yield efficiency of the capital you already have. The first vehicle is the Dividend Aristocrat. These are well-established S&P 500 giants, including household names like 3M and Walgreens. To qualify for this category, a company must have increased its dividend payout every single year for at least 25 consecutive years. This chart shows how the math changes at this level. With an average yield of 7%, the required capital for our goal drops from $2 million down to $500,000. While $500,000 is still a significant investment, these companies are built for long-term consistency, often maintaining their payouts even during difficult economic cycles. Aristocrats represent a middle ground, offering a more attainable capital goal without sacrificing portfolio reliability. If you need more efficiency, you look toward real estate investment trusts, or REITs. These trusts own income-producing assets like apartments and office buildings. Legally, they must pass the majority of that rental income directly to their shareholders. This visual indicates the new target. By focusing on high-yield REITs with historical returns averaging over 10%, the required capital shrinks to approximately $320,000. Many REITs also pay out dividends every month. This makes them highly effective for covering recurring monthly expenses like a mortgage or car payment. However, these payouts are sensitive to the economy. If vacancies rise or commercial property values fall, the yield can become volatile. REITs offer an aggressive cash flow engine that requires less capital, provided you can handle the fluctuations of the real estate market. The most aggressive shortcut involves covered call ETFs. These are unique funds that generate income by combining stocks with options contracts. The fund holds stocks while selling the right for others to buy them, collecting an upfront premium. That income bundles with standard dividends for double-digit yields. Your required capital drops to its lowest point. Roughly $280,000 hits the target. The trade-off is capital risk. If the market drops sharply, these funds lose value quickly, and options won't fully protect your initial investment. Covered call ETFs are the ultimate accelerator, reducing the initial investment by 85%. This matrix places our 3 options side by side, revealing a fundamental law. As the capital requirement goes down, the risk to your principal goes up. Chasing the lowest possible investment amount, the $280,000 target, leaves your portfolio exposed to market shocks that could disrupt your income. Minimizing your upfront capital isn't a shortcut around the rules of the market. It is a deliberate choice to accept higher volatility in exchange for faster cash flow. A sustainable income stream is rarely built on one single asset. It requires balancing these 3 different strategies to protect your progress. Most successful investors build a hybrid portfolio. They don't pick one path, they combine all 3. This architecture uses Dividend Aristocrats for safety, REITs for monthly liquidity, and a smaller portion of ETFs to boost the overall yield of the entire portfolio. The final element is compounding. By taking early dividends and immediately reinvesting them to buy more shares, you turn the portfolio into a self-fueling machine. While the exact timeline depends on your personal savings rate, this strategy of high-yield reinvestment aims to reach the finish line much faster than the decades required to build a traditional $2 million fund. Financial independence isn't about waiting for a $2 million miracle. It's about engineering a smarter, more efficient route to the monthly income you actually need.